This is the stock valuation for Entravision. Just a quick disclosure. Um, I am not invested, nor have I been following this company. This was a request by a subscriber to analyze this company, and I am more than happy to do so. Had a lot of fun doing it as well. I'll put a link to the earnings call summary on this video as well, where I do discuss the business and what they do. This one will be strictly numbers. So first things first, again, really interesting company to analyze. One of the biggest issues comes in the form of their intangible assets not subject to amortization. As you can see, it is a huge number. It is literally, a quarter of their total assets. Typically, I don't include intangibles because intangibles, um, you know, there, it's very hard to evaluate an intangible. An intangible is something that is not real. Okay, it's not a hard asset. It's not something that you can hold in your hand, and so trying to evaluate that thing becomes very complex and complicated. And so I typically do not use intangibles. In this case, I had to. I don't have a choice. So I did not include the intangible assets subject to amortization. A lot of those were simply just amounts paid over the purchase price of new companies that they purchased. Same thing goes with goodwill. I did not include goodwill. A lot of that, again, is just simply money that was overpaid for companies that they purchased. However, the intangible assets not subject to amortization, a lot of this is broadcast licenses. And even though we can go through and figure out exactly how much broadcast licenses cost, which I found out were not that much, um, the way that the company is evaluating these things is what the issue is, which is an income-based approach, which is, the way it's supposed to be done, but it makes things very complicated for analysts to really figure out, what the company actually owns. So I just wanted to go through this just very quickly before we get into this to make sure everyone understands kind of what's going on here and why this can become a precarious situation. So they discuss in their financial statement to the SEC exactly how and why they're accounting for these intangible assets like they are. Okay. And so it says the income approach estimates fair value based on estimated future cash flows of each reporting unit, discounted by an estimated weighted average cost of capital that reflects current market conditions, which reflect the overall level of inherent risk of the reporting unit. So what this means is that they're taking these broadcast licenses and they're saying to themselves, okay, how much money can someone make off of this broadcast license? All right. And then we're going to assume that they'll be able to make this money for a certain amount of time. What those calculations are, what those formulas are, we don't know. All right. We don't know if maybe they're assuming that you're going to make money off this broadcast license for 20 years, for 10 years, for 5 years. We just don't know. When you purchase these broadcast licenses from the FCC, you do have to renew them every year. If the FCC doesn't want to renew your license, they don't have to. So even just the timing of how long this broadcast license is going to allow them to make money, no one really knows. Honestly, if I were doing this job, I would simply go back and look at maybe how long some other companies in the industry were able to use their broadcast licenses, or I would go back and look and see how long we've been able to use our broadcast licenses from purchase to termination. The other thing is how much money can be made with these broadcast licenses. Again, that's something that you typically average over a certain amount of time. You can use other companies' numbers. If you have access to them, you can use phone numbers. Um, the problem with doing that is that, again, you can only use something of an average. You can only kind of guesstimate how much money will be made. The other thing and I said this in the earnings summary, is that radio and TV are declining businesses. They're no longer growing businesses, and so the money that is being made from regular TV and regular radio is declining. And so we have to wonder whether or not that declining income is factored into their equation. I've said before that when you present financial statements to investors, you want to paint a pretty picture, right? You don't want your business to look bad. And so I am sure that they did not include those declining values in their calculations, right? Now, when it comes to the tax man, different story, right? When you file your taxes, you want the company to look horrible, and we'll get into how that plays into this in just a second. Um, it says we also estimated the terminal value multiple based on comparable publicly traded companies in the television, radio, and digital media industries. We estimated our revenue projections and profit margin projections based on internal forecasts about future performance. Uncertain economic conditions, fiscal policy, and other factors beyond our control potentially could have an adverse effect on capital markets, which would affect the discount rate assumption. Okay, now that's the other thing, the discount rate. So, financial math, what it does is it takes, let's say, $1,000, and it says, okay, we're going to make $1,000 for the next 10 years. Okay, well, that's $10,000. That's very easy math. But what is that $10,000 worth today, right? Well, that $10,000 today is actually less than 10,000 because we assume that if you were to make $1,000 every year, you'll also be able to make money with that money, right? The question is, at which return rate will you be making money on that money? So let's just assume that we're going to use the risk-free rate, which is what's used in a lot of financial mathematics. The risk-free rate is the amount of money that you can invest in usually U.S. government debt, right? Because it's risk-free, okay? Right now, that's about 2%, a little more than 2%, right? And we assume that we can at least make that. If we can't make anything else, we can at least make that, right? And so that's the reason why that number is usually used as a discount rate. Okay, now here's the thing. The larger the discount rate that you use, the smaller the number becomes. And so again, you want your financial statements to look pretty, right? And so you want to show that your assets, right? You want to show that your assets are huge. You want to show huge assets and you want to show small liabilities, right? And so I imagine that this company is going to use a return rate that is going to be smaller than what they may actually be able to make money with. And let me explain what I mean by that. So again, in financial math, the easy thing to do is to use a risk-free rate, which is a very small number, which means that your asset is going to be large, right? But in reality, how much money can you make with that money depends on what you do with that money. Do you use that money to purchase other businesses? Do you use that money to invest in other companies? Do you use that money to loan out to people? There's a bunch of things that you can do. Do you use that money to invest in your own business, such as hiring more employees, such as research and development with new technologies and so forth. So, and when you start thinking about that, well, now your what do they call the weighted average cost of capital can be, who knows, 10, 15, 20%. We're also talking about a company that is growing revenue like crazy because they're getting into a new business. So again, it becomes very difficult to accurately evaluate the intangible assets in this way. So I didn't even try. I'm going to assume that this 209,053 number that we see here is the number. There's no way for me to even try to evaluate this stuff on my own, nor did they break out exactly what is actually inside of this intangible assets not subject to amortization, they just describe what can be in there, right? They did break out a little bit of the intangible assets that are subject to amortization, and they did break out a little bit of what the goodwill is. But again, we're not using those in our calculations. Okay, we're only going to use this 209053 number. All right. Next thing concerning these intangibles. All right, this is what they are. So the indefinite life intangible assets. Here's another issue. So typically, as far as the IRS is concerned, every asset has a definitive life, meaning that if you have a house, that house has a life of 30 years or 27 years, right? If you have a car, that car has a life of 5 years. We assume that at the end of that 5 year period, that car is no longer going to be worth anything, and you're either going to sell it or throw it away. Okay, that's the way the IRS works. In this case, they're making an argument that these broadcast licenses are indefinite life intangible assets, meaning that they don't have a definitive life. And because they don't have a definitive life, then they don't amortize them, they don't depreciate them. So if they purchase this broadcast license for $50,000 and then they think they're going to make an additional $100,000, now all of a sudden this broadcast license that they purchased for $50,000 is actually worth $150,000 on their books, and they're actually able to go out and get loans against their $150,000 that they only paid $50,000 for. Okay, that's how this stuff works. All right, now what they do though is every year they're required to evaluate the value of these indefinite life intangible assets, and every year they do what's called get the word, it's in here somewhere. 1 second. Yeah, impairment charge. Every year they do an impairment charge. Okay, and the link to these articles, of course, is going to be in the video, so you can come read them yourself. But and by the way, I think you can see this, but at the bottom, I use a control find function in order to find this stuff, because it's a huge document, lots and lots of pages. So without control find, good luck, right? So anyway, impairment. Every year in October, they do a new valuation on what these actual intangible assets are worth. Okay, and so if they find that the asset is not worth as much as they thought it was going to be worth, which is almost every year, then they record what's called an impairment charge. Now, this impairment charge is not a real cash thing. Okay, it's not like it's actual cash coming out of their pockets, right? It's just a tax thing. Okay, and so that's the reason why I'm not including the impairment charges in the analysis for this company. Okay, now this happens every single year. This does affect their net profit, of course. This does affect their tax return, of course, but it is not actual cash that they're paying, and so I don't care about it. All right. The other thing that you'll see here is a change in fair value of contingent consideration. So this company has been purchasing lots of companies. All right, and so what they've done is they have entered into an agreement saying that, hey, we're going to pay you, let's just say $10 a share for your company, and we're going to do this by December of 2022. Right now, today is June of 2022. So they're going to record on their books because they made the agreement that they're going to pay it, right? And let's just say the stock is worth $10. All right, now on December, when this transaction actually takes place, maybe the stock is now at $8. Well, now what that means is that they have to go back and they have to do a change in fair value of contingent consideration for the remaining $2 per share. Okay, and so that can go both ways. Maybe they say, hey, we're going to buy your company, and they say, we're going to do it at this price, and then maybe in December, now the stock price is $12. Okay, and so now instead of paying 10 per share, now they're having to pay 12 per share. And so they have to go back and do a change in fair value of contingent consideration, because as soon as they say that they're going to buy the company, they have to book that. They have to put that in their, have to put that in their reports. They have to account for that. All right. And so this change in fair value of contingent consideration, again, comes out of them buying these companies that they've been purchasing over the last couple years. And I think will continue and maybe even accelerate, because this company, again, is getting out of, well, I shouldn't say they're getting out of, what they're doing is they're getting into more of this digital online advertising business. Yeah, and they're just growing that, right? So they're still primarily a TV station, radio station, but they're definitely growing this digital online business quite a bit. And I think at some point they want to become just that, and they want to kind of get away from the TV and radio thing, which means that we're going to see huge impairment charges, which will again affect their net profit. The other issue with this I want to bring up is that when analysts are trying to predict the net profit for the company quarter to quarter, they have to take into account these impairment charges. They have to take into account this change in fair value of contingent consideration. And that becomes very difficult to do. And so what can happen a lot of times, what has happened this past quarter, is the company failed to meet the expectations of the analyst, right? As an analyst, you have a choice, and this is where it gets political, right? You can be very conservative in your analysis, or you can be very optimistic in your analysis. And that's the reason why you have differing opinions and you have differing price projections for these stocks. And a lot of times, stories are told that analysts are being paid under the table, backdoor types of deals, where they're saying, hey, we'll give you X to this, we'll give you tickets to this if you give us an optimistic report. And it's very easy to do, because remember, a lot of this stuff is subjective, specifically for this company, because like I said, a quarter of their total assets is intangible. Like it literally cannot be counted. And how you decide to count it is completely up to you, right? And so that can happen. And so that's the reason why this company may fail to meet those profit expectations. I did not look at the history of them beating or meeting expectations. I didn't think that was necessary for this particular analysis, but it is something to think about and look at, because a lot of times investors will literally buy or sell a company simply based on quarterly reports. If they missed revenue and net profit, they sell the company. If they beat revenue and profit, they buy the company. And so that can have a lot to do with the price as well. All right, let's get into some of these numbers. First things first, again, this is the 2021 10K, all right, it's their annual report. This is the 2022 first quarter report, okay? And then what I've done is I've used a bit of statistics to try to predict what the 10K end of year 2022 report will look like, to give us an idea of where the stock price can go within the year of 2022. Now, keep in mind, it is June of 2022. So the stock has already been up and down this year. But again, this is only talking about 2022. We can't really predict out to 2023. That would be a little too far. Even though it is possible, I'm not going to try to do it. All right. So first things first, cash has increased over the last 3 years. All right. Again, I want to say, I'm sure I've said it before, 3 years is statistically significant. Ideally, when using statistics and looking at numbers and predictions, you want as much data as possible. Mathematically, 30 years is like, beginning to be the best. statistically speaking. Um, 30 years is kind of the minimum for statistical significance. We don't have 30 years of data to look through. That's a lot of work. Even doing something like a 9-year analysis where you have 3 of 3 years will be better. In this case, we're using 3 years, which gives us a very tight um, prediction radius. And that's the reason why I don't try to go out too far, right? 3 years really kind of just gives us what to expect right now today. It can't really predict out very far. But 3 years, like I said, is statistically significant because it's kind of an old adage, right? One time is a fluke, a second time is is what's the word? Starts with a C. Um, Coincidence, yeah. Twice is a coincidence, 3 times is a pattern, right? It's just kind of an old adage, but it's very, very human, and there's a lot that can be said about that. And so that's the reason why we're using 3 years. So over the last 3 years, they have increased their cash position every single time. On average, something like I think 16%. I forget what it is. So we expect that to continue. All right, so 2021 cash was 185,843. Currently, right now, as of May 2022, I'm sorry, I think April, I forget, but reported as of May 2022, they're sitting at 212. So they've already increased their cash position. So we expect that to continue. So end of year, we expect it to be somewhere around 226. All right. Receivables again over the last 3 years have increased quite a bit, a lot actually. And so again, we expect that to continue. 2021, they were at 201. Currently, they're at 173. And so it is possible that they can almost double that by the end of the year. That's something that if you wanted to get down into the details, you would have to do a quarter by quarter analysis because sometimes there's some seasonality in this stuff where some companies make all of their money at the beginning of the year, other companies make a lot of money at the end of the year, and some companies make a lot of money like in the middle. So again, I don't know what the seasonality of this company is, but we do know that they have increased their receivables by a lot over the last 3 years. And currently, like I said, they're only at 173. They were at 201 last year. I don't expect them to change. So something like doubling, I don't know. That's kind of hard to figure. So maybe that's a number that we'll play around with later. All right. Next thing is assets for sale. Now they have been not necessarily selling stations, but they have been getting out of some stations. I think some of their broadcast licenses have expired and they chose not to renew. So I don't expect there to be a lot of selling going on, but they are getting out of the TV and radio game. It's hard for me to even say that because not only have they not said that they're getting out TV and radio game, but they haven't been aggressive in doing so. But it is true that they are letting some licenses lapse, and they do have literally assets on sale on the books every year. So it was what 2141 in 2020. It dropped to 1963, means that they sold some stuff, and currently it's still sitting at 1963. Statistically, that number can increase, but honestly, I don't think it will change much at all. So let's drop that to 1963 for the year. I don't think they're going to add any assets to that. All right. Other assets. Now they have invested in quite a few businesses where they own like equity. Maybe they own like 50% of this business, 25% of this business, so forth and so forth. So that's what these other assets are. Over the last 3 years, it looks like that number has declined. I do know that they are purchasing other businesses. They did not speak in their earnings call about necessarily doing any joint ventures or anything like that, but we do know that they have again invested in some other businesses. So Currently, they're at 209. Again, this is as of May 2022. Last year, they were at 243. And so we do expect there to be a decline. And so we have it at 217,834. All right, which is a small jump from where it is now. So I think I'm okay with that. All right, prepaid expenses. This is going to be a lot of things. Again, just that they pay ahead of time before they use. It's just a common thing. But it is important to note that this number has moved around quite a bit over the last 3 years. And so it becomes really hard to use an average. A lot of times in this situation, I prefer using something of a standard deviation. It was 18 in 2021 and it jumped to 36 in 2022. So we're talking about 100% increase. Um, and again, there may be some seasonality in this, right? And so we expect the number to, increase from 2021 to 2022 to roughly 24.6, which means that a lot of these prepaid expenses are going to have to be used, right? So they've already paid for them. And so as they use these services, as they use these products, then that prepaid expense number comes down and it comes off the assets. And so again, a number that we can play around with right now. I'm okay with that number growing from 18 to 24. That's not really a crazy number, but the fact that it's at 36 now is a little weird. All right, property. Now they are a TV station, so I imagine that a lot of their property is going to consist of, satellites and TV station buildings and so forth. But it has slowly declined year over year again because I think that they're kind of getting away from the TV radio game just a little bit, right? Without saying too much, just my opinion. And so in 2021, they were sitting at 62. Currently, they're at 60. And so we have a prediction of 55, which means they're going to have to get rid of quite a bit um, to make that number possible. Let's see, drop 10%, drop 13%. So I think 10% is a decent number. So what I'm going to do is I'm going to just assume that it's going to drop by 10%. And so that gives us 56 versus 55. So yeah, I'm okay with 55. I'm okay with 55. Again, maybe it's a number that we play around with. All right, tax. Getting into the liabilities here. Okay, so this is taxes owed. All right. Last year they were at 66. Currently they're at 66. This number has increased though, and I think that has a lot to do with again them kind of changing their business, not structure, but changing their business. They're getting more into the digital online ad space. And so anyway, um, the taxes have definitely increased. Um, and so on average, it looks like maybe 20% a year, just quite a bit. Like I said, currently sitting at 66. They were 66 last year, so I'm okay with that 80. All right, investment. So this one I don't know if I have this queued up. Let me see. Uh, yeah, here we are. Redeemable non-controlling interest. Okay, so non-controlling interest is basically going to be a company that has that owns a piece of this company, right? But they don't own enough to control it, right? So maybe they own like, I don't know, 2%, 3%. Like there's an actual number and limit that they have in there to be able to call it non-controlling, right? So um, someone, right, somebody owns a piece of this company, Entravision, and now Entravision owes them some money. Now that has only happened in the past 3 years. It's only happened once. Again, if we go back 10 years, who knows how many times this happened, but In the last 3 years, it's only happened once. And so we don't expect that to happen again. And that's why you see just this blank number here. Okay. All right. Debt. Debt has increased by quite a bit. And so on average, we expect it to continue to increase. Looks like it was 52 last year. It's currently sitting at 54. Again, the numbers look kind of crazy to think that you're going to go from 52 to 67 in debt. But again, that's what the numbers say. And so, again, this may be a number that we can play around with, but right now I'm happy with it. Like I said, it's currently sitting at 54. So to get from 54 to 67 is a jump, but they've made that jump consistently over the last 3 years. So, all right, and so that gives us a net balance of 11. Oh, I'm sorry, 115. Currently, they're sitting at 84. And last year they were at 121. And as you can see, over the last 3 years, they have a declining balance sheet. A declining balance sheet. Now, in a lot of situations, you don't like to see a declining balance sheet because that usually means that you owe more than you own, right? In this case, I think because this company is changing and kind of moving into a different thing, I think we can kind of put the declining balance sheet to the side. Also, though, I do think it is important to note that, again, this kind of goes along with the story that TV and radio is a declining business itself. So you expect to see a declining balance sheet from TV and radio companies. But again, the story behind this company, what's so exciting and what they talk about in their earnings calls is this new online digital advertising that they're getting into, which doesn't require really a lot of assets such as property and equipment and so forth, right? Because it's mostly online digital computer stuff. So again, in 2021, they were sitting at 121 as a total net balance sheet. Again, I'm not including any of the intangibles. I'm not including any of the depreciation and so forth. Okay, so this number is not going to look anything like what you'll see on Yahoo Finance or NASDAQ or any of that kind of stuff. All right, but again, the numbers are the numbers. We got them from the SEC earnings reports. So they're currently sitting at 84, which is quite a drop. Let me see. It's quite a drop from 121. Just curious now. Uh-oh, what am I doing here? I'm just curious what that drop is. So a 29% drop. And we know that they dropped 28% um, last year in 20. So, I mean, honestly, at this point, and listen, they're currently at 84. They're currently at 84. They were at 121 last year, which is in line with with their consistent decline, right? We're predicting 115, 357, and again, this prediction that you're looking at here is based on these numbers. You know, this isn't based on the numbers down here. This is just doing the math from what we have here, right? And so the question becomes, if this number 115 is too high, right? Then what can we increase on the liability side, or what can we decrease on the asset side to put us more in line with maybe this 84, 85 number? I don't know, something to look at, but we'll kind of come back to that. All right, number of shares. The number of shares has increased all but slightly over the last 3 years, and so we expect that to continue. Now, here's what's happening though. They did do a $20 million repurchase of the shares, and the CEO seemed more than happy to continue, purchasing shares and retiring them in the open market space. And so they're currently at 85. Okay. They were at 86 in 2021. And like I said, over the last 3 years, they've slightly increased the number of shares, meaning that they've issued more shares. And companies do that to bring in more cash to purchase other companies. A lot of times they'll issue shares to pay their employees, their executives. And so will this be the first time in 3 years that their share count is actually down versus up? I don't know. But I will tell you that the number of shares does, in fact, reflect in all of our ratios here. So again, they're at 85. I'm just going to assume they're going to stay at 85. We can very easily do an increase from the 86 that they were at last year. Um, but the fact that, again, they were 86 last year and they're currently down to 85 now, maybe this is the first time in 3 years that they've reduced their share count. I mean, it's not out of the realm of possibilities. And so as of right now, we'll kind of just assume that that's what's happening. All right, so that gives us a book price. And again, this is the price of the actual company relative to, again, assets and liabilities, what the company actually owns and owes, $1.35. All right, now, is that how much you're going to pay for this stock? Of course not, because when you're purchasing a stock, you're purchasing the future earnings of the company. And so the company is always going to be worth more than what they actually own. Again, this does not include any of the intangibles or depreciation and so forth. So that gives us a price to book of roughly 4. So you're going to roughly pay 4 times what the company actually owns as a stock price. That gives us a 28%. The stock price is made up of 28% of the book price. Okay. Now, going back historically over the last 3 years, at the high of 2021, the book value made up 15% of the stock price. Because again, as people become more excited about the company, they're willing to pay way more than what the company is actually worth, right? So at the high, 15% in 2021, 61% in 2020, and 65% in 2019. I think that is very telling. Now, in 2021, we know that we had this V-shaped recovery. There was a lot of excitement. I think maybe that TV and radio had a push because of COVID. Maybe the story was that people were staying home, and so they expect TV and radio to really increase in usage as well as advertising dollars. Maybe that's what's going on because in the last 3 years, it's never been 15% of the stock price at all. So the fact that we're at 28%, which is really kind of unheard of over the last 3 years, other than last year, kind of puts us, still at the top of where this stock price can go. So at the low, the stock price was 51% of the book price. In 2020, the stock price was 180% of the book price. And so what that simply means is that I want to make sure I get this right too. The yeah. So the book price was a dollar 98, but the stock is trading for $1.10, meaning that the company is trading below what it's actually worth. And typically, when that happens, that is a buy signal from the gods, right? Because if you're just looking at assets and liabilities, you're telling me that if this company were to sell everything that they own, the cash that they'll receive from selling those assets is going to be worth more than what the stock price is. then buying the stock at $1.10 is just making money, right? Just no question about it. And honestly, if you just look at historical prices from $1.10 up to $9.34, you're talking about like a 800% increase on your money. I mean, that's crazy. So when you see a number like this, 180%, again, that's just a buy signal from the gods. Same thing happened in 2019 too, though, where it got to 111. So, I mean, again, based on historical data, this company has definitely been there before, and so 28% to me is still sort of in at the higher end of the company's share price. And keep in mind, even though the stock rather is currently sitting at $4.77, because of the declining balance sheet, the stock can actually go lower, but if the balance sheet goes lower faster, then you'll still see this number in that 20 to 30% range, which is actually historically where it has been. So again, this may be, and I haven't followed the stock very long, or I haven't followed the stock at all, rather. And so I think maybe there was a lot of excitement around this stock. I think there was a lot of talk about meme stocks over the last year or two, where you have just some companies that, for whatever reason, become very popular with retail investors, and sometimes with industry investors as well, because the industry investors kind of keep an eye and ear out for what the retail investors are doing. Not only that, but retail investors sometimes really do move markets, because if the retail investors say, hey, we all want to buy Entravision, well, the big banks and the big investment firms, they have to buy Entravision too, to make sure they can cover the stocks that the retail investors want. So maybe that's what's going on here. I don't know for sure, but clearly something drastically changed in the way the stock performed from 2019 to 2021. And I can, at this point, only speculate as to what that was. But what's important, though, is what does this mean for the future of this stock? Is it going to stay at this heightened level of excitement, right? Or are we going to slowly get back to where they have been over the last few years? So again, 28% I think is kind of right in the middle, but I'm going to say at the higher end. Okay, so based on that, we have an estimated price of $1.18 as the absolute low for the year of 2022, and we have $2.87 as the absolute high for year 2022. Now, of course, that seems ludicrous, being that the current stock price is at $4.77, grossly overvaluing this company by more than what I've ever seen. But again, let's try to see if we can get this number to increase to something, more, something that makes a little bit more sense, right? So first things first, we talked about the declining balance sheet. It's currently at 84, was at 121. So let's see if we can decrease some assets here. So I think the first thing we do is we attack the intangibles, because remember, we know for sure, okay, that those intangibles come October 1st, which is going to make it onto the fourth quarter 2022 earnings report, is going to be hit with impairment charges, right? So let's go ahead and let's drop that by, let's just see. So it decreased 5%, and then it decreased 15%. Let's assume it decreases by 20% maybe. I mean, that's kind of a big jump, but and then the prepaid assets again, they're currently at 36, and we're expecting to get down to 24, which is still an increase from 18. Um, let's drop that to let's do this. Let's keep it at let's keep it at 18. Let's see what happens there. We'll keep the property the same, and so that gives us now a balance of 86, which is I think more in line with what it has done, like I said, over the last 3 years, um, from 121 to 86. All right, so that gives us now a price of absolute low of 88 cents, absolute high of $2.15. Okay, let's now and see now you see why this is kind of ridiculous, right? Because to the only way to improve this price um, will be to increase the balance sheet balance, which it's just, I mean, again, maybe if we go and look over 10 years, maybe that makes more sense. But looking over the last 3 years, that just doesn't make any sense at all. Let's play around with the shares. Let's assume that they're going to increase their share count as they have done over the last 3 years. And we don't need it to increase by a whole lot, but it does increase a little bit. And that still gives us book price of $1.15 at the low, 2.79 at the high. I can't I can't I can't I can't do this any other way. Let's drastically reduce our share count, right? Let's just say that not only do they spend all of the money in the repurchase agreement, but maybe at some point in the year they decide that the stock price is just way too low and they're going to repurchase even more, okay? Which I seriously doubt happens, right? But let's just assume for fun right now, right? That still gives us only a high of $3.15. So again, none of this is making sense. And what that means is simply that this stock price does not move with the balance sheet. The market can care less what this company owns and what this company owes. That's basically what that means. It means that this company can probably take on a whole bunch of debt. They can get rid of a bunch of their assets, and the stock price will still not care, right? Like the stock price won't fall based on the information. Now, let's go to our, get rid of that. All right, let's go now to our um, profit loss statement. And quickly, before we get there, I do want to just point this out very quickly. They do have a dividend. The dividend is pretty decent. It's at 2% a year, which again, like I said, it's a decent dividend. But they have way more than enough cash to cover that dividend. Also, want to say that they did slash the dividend by half. Um, if you look at 2019, you see that the dividend cost them was that like 10,629, and the year before it was 16, and currently their dividend is only like 86. I'm sorry, no, currently only 85 versus 86. They slashed it last year, and so now they have way more than enough cash to pay out these dividends. Personally, as a dividend investor, in a situation like this, I either want to see the company purchase more companies to help grow the balance sheet and profit, net profit, or I want to see them increase the dividend. Because what else are you doing with that cash? I mean, that is a lot. You can pay this dividend 20 times over. 20 times over and still have cash left over. And from the profit, you can pay this dividend 10 times over. So you can give me 10 times the dividend. You can increase the dividend to almost 20%, and still run the business like usual. So definitely really good there. But again, there are some questions. And by the way, none of this was brought up in the last earnings call. Only the repurchase of shares was mentioned. All right. So revenue has increased a lot, okay, a lot, because again, this is a changing business. So the revenue increased almost 120% last year, 25% the year before that. So we do expect revenue to continue to increase. 2021, it was at 760. It's currently only at 197. Again, I believe there's seasonality in this. Um, that 197 means that if they were to make this every quarter for the rest of the year, they would only be at like 800, which is a very small increase from 2021. Based on the numbers from the last 3 years, I don't think that's the case. So I've predicted that income is going to increase a lot to, what is this? It's hard for me to even say this number, to 13,178.74. All right. So a big jump. Basically about what, 60,000 more, or 60, was it 600 million more, something like that. Anyway, revenue is going to increase by quite a bit. What is the story though, and this was discussed in the earnings call, is the increase in cost of goods sold, the money that they're spending to make this money. If you look back over the last 3 years, their gross margin was 57%, 62%, and then 77%. What this means is that every single year they're spending more money to make more money. And so what I mean by that is, if I use $10 to make 100, that's good. No one's going to argue that, right? If the next year I use $20 to make $110, that's still good, but not as good as last year. See my point? Even though I made more money than in the next year, I spent more money to do it. So while it is nice that the company is making more money, you don't want them spending more and more and more money to make that money. Now, again, this is a changing business. Um, is their gross margin going to stay at this, roughly 77, 80%, or is it going to continue to increase? If it continues to increase, that's a real problem. A real problem. Um, if it kind of stays where it is, then we can deal with that because, like I said, it's a changing business. We get it. You're changing, right? So maybe this is just what it's going to be from here on out. And it's the kind of stuff that analysts look at, right? Because we're trying to figure out what the net profit is going to be, and we have to have some idea of what you're going to spend to make the money that you're making. So again, they're doing great with increasing revenue, but I think just because of the change of the business, they're having to spend more and more money to get that revenue. So again, what I did was currently right now, the gross margin is 80%. I don't know if there's seasonality in that, but I believe that number because in 2021, as reported by them, it was 77%. And so my prediction is that it's just going to stay at 80, right? Like it can definitely go higher. I think that that's kind of a worst case scenario. I think that 80% is probably where they're going to stay. If it gets higher than that, that's a real issue. All right, payroll. Payroll has steadily increased. Well, not steadily increased, but it has increased over the last year or so. This is a conversation that's being had by everyone, really just across every sector concerning um, 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 concerning labor, right? The other thing to mention here, I'll show you just really quick. I did include what is called corporate expenses. And so the selling general administrative expenses that's payroll for the most part, right? But they also have these corporate expenses. as well that I've included in that payroll number. What those corporate expenses are exactly, it is, you know, who cares? Because it's going to get paid. But a lot of it is going to be like executive pay. There may be corporate jets. There may be, maintenance on corporate buildings. Who knows? The point is we know the number is there, so it's going to get included, and we know that that number has steadily increased. Now, if you want to try and tease out the difference in rate of change between corporate expenses and the rate of change in the actual payroll, that's fine. I don't think it's necessary. I think that overall the number will kind of, and you see it's kind of going back and forth a little bit, but for the most part, it's steadily increasing. I think that's going to be the same for everyone right now. So based on just an average over the last couple of years, 94, and we were at 89 last year. All right, tax. Tax is all over the place, and I think this has a lot to do with them purchasing these other businesses. They haven't talked much about the tax, other than the fact that they're having to pay both state and foreign taxes. Something that I didn't mention, but they are expanding in a bunch of countries, specifically Southeast Asia, specifically Africa, and they've been in Latin America forever. But Southeast Asia and Africa is where they're expanding into, and so with that comes more regulation, comes more taxes, more reporting requirements, and so that number's just been all over the place. Been all over the place. Last year was 18. Currently, it's only 852. So I really don't know what to do with that number. I really don't. But because it was 881 in 2019. It was only 15 in 2020. I'm looking at 9,000, which is like half of what it was in 2021. Maybe that's a number that we can play around with, but the fact that it's currently at 852 is kind of, I don't know. Again, maybe it's a seasonality thing. Maybe most of the taxes get paid, later in the year. All right, foreign exchange. This was something that was talked about quite a bit. Over the last 3 years, they have done really well with making money on their foreign currency exchange, right? So again, they're in Africa, they're in Southeast Asia, they are in South America. They talked about Argentina having a high inflationary environment, and because of that high inflationary environment, it changes the way that they account for some of this stuff. But again, over the last 3 years, they've done really well, and so we expect that to continue. In 2021, they actually were up. That's what this negative number means. They were actually up roughly 65. Currently, they're at 9, and so I expect that number to, to increase from where it is now. Whether or not, 54 is kind of what I'm predicting, just based on an average. But yeah, who knows? Maybe we can look at a standard deviation on this instead and see if that gets us a bigger number. Because I think it will. I think it will get bigger here. So anyway, all right, that's it. Interest. This is another place in which they've done really well, just in their financing, right? This is where the CFO really shows his worth, right, in that foreign currency and this interest. This is not a bank at all, but they have interest income every single year. Not only that, but the interest expense that they pay. Show you what that looks like. Um, yeah, the interest expense that they pay is actually a benefit to them. How that happens, I don't know. Um, and also, too, this has a lot to do with just the way this is written and reported, right? So, and this is something maybe I'll play around with, but this is an income tax benefit, and then parentheses it says expense, meaning that when you see these numbers in parentheses, this is actually how much they've paid in taxes, right? Here, though, on interest expense, right, there is parentheses around these numbers. And so I expect that that is an actual gain in interest. Same goes for this foreign currency gain in parentheses, right? So whoever is responsible for writing this, which is typically someone in the accounting department, um, they didn't explain this well at all. Interest expense is an expense, but when you put it in parentheses like this, I assume that it is a gain in interest and not an expense, just as they've showed everywhere else on the earnings report. So somehow they have made money not only in interest income, but also on the side of their interest expense. And I imagine that maybe this is a situation where they have a deal in place where they have to pay, let's say, 2% on a loan, but if inflation goes up, I'm sorry, not inflation, but as interest rates increase, um, possibly their interest rate stays at 2%, and so maybe they're booking the difference between what the interest rate actually is and what the interest is that they're paying, and so that's a benefit to them. I don't know specifically, honestly. I may go back and try to dig some more to figure this out, but currently, right now, this is definitely a benefit to them. It was 72 last year. It was 10,000 year before that, 17,000 year before that. So it has definitely increased. And so, mm, so I need to actually increase this by more. That okay, FD. And I saw this somewhere else too. There you go. So, 17 to 10. No, no, no. That's a problem. If I can figure this out. Okay, so that's right. So it is a 40% decrease for sure. And then, yeah, this is definitely a decrease 10 to 7. Okay, so I had this right initially, and I just doubted myself. Sometimes the negative numbers throw me. All right, so anyway, so this interest income has declined over the last 3 years. So we expect that to continue. It's currently at 22. And so a jump from 70, I'm sorry, from 72 to 47 seems about right. Okay, so investment. Investment is a weird one too. The, Show you what I did with that one. So there's two things. There is, where'd it go? So dividend income. Remember, this company owns other companies. They own pieces of other companies, and so they receive a dividend. There it is, dividend income. So they receive a dividend from these shares of companies that they own. But there is also two other operating gains and losses. Again, this comes from those other companies that they own. Okay. So as you can see here, the other operating loss and then in parentheses gain, right? So all you see all these gains. All right. So this is money that they're getting from these other companies that they own a piece of. And then, like I said, they're also getting dividend income as well. And then you see back here, 2019, there's a gain or loss on debt extinguishment, just meaning that um, if they have a debt that they owe, and let's say they pay it off early, sometimes if there's a fee that you have to pay in order to pay off a debt early, and so that gets booked as debt extinguishment. Sometimes too, if they are loaning money to someone, what'll happen is they'll book the future interest from that loan, right, on their books. And then if the company pays off the debt early to them, then they'll have to now discount the interest that they booked earlier, and they'll do that as debt extinguishment. All right, so the reason why I bring that up, though, the reason why it's so important is because this number has been just really all over the place. So as you can see, in 2019, it was at 58. 2020, the dividend income was 28, and then in 2021, it got all the way up to 8,000. So it's just a crazy number. And currently, right now, let me show this real quick. Where is it at? Okay, so I think it's the only one I have. But is this 2022? Oh, this is not 2022. I think 2022 is. If I can find it real quick. This 2022? Nope, that can't be it. I think I got rid of it. Yep. All right. Sorry. Well, I did have the 2022 quarterly report pulled up, but I got rid of it. So anyway, they did report a loss on investment of 5,097. Um, First time that's happened in forever. Well, last 3 years rather. And so the question becomes, is that going to remain on the books, or is that going to change between now and the end of the year, being that it has always been a plus for them? So I don't know. I really don't know. But again, that's something that we can kind of play around with. All right. So last but not least, we're looking at net profit. Net profit has grown year over year, and that's really good. And so last year it was at 90. Currently it's only at 11 or 12. And so we expect that to jump to roughly 165. The problem with that is, though, is that that gives us an 82% increase, and I don't think that's going to happen. And so the only way to get this 82% down to something normal that we've seen over the last 3 years in the 25-30% range is, I think we have to get rid of this investment. Let's see. No, that didn't do it. Seven. No. Yeah. The only way to do that is we have to uh, either reduce the revenue, we have to increase cost of goods sold, or we have to drastically increase the tax. And I think maybe that's a way to go for sure, is just assume that the tax is going to be whatever it was last year, but that still gives us a 72% increase, which is just it's just way too much. So the other option that we have here is we can assume that I keep wanting to play with this investment number. Yes, that's not going to do it. Um, we can assume that maybe, even though it is kind of ludicrous that the number has, you know, drastically changed over the last few years, maybe it doubles from here. I don't know. The foreign exchange, maybe the foreign exchange uh, is just not as great as it has been. We do know that. I mean, it's always been something, but it's only 900 now. Mm, let's see what happens if we just make it the 900. Just assume it doesn't change. It still gives us a 67% increase. Um, I don't know what else to do here. Let's 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 say maybe the payroll um goes up by more. Maybe let's do a standard deviation on this thing. Let's try that, and we'll do uh, um, ABCDEFGH. All right. That can't be right. What did I do wrong? D F H D F H. Oh, I get it. There you go. Because we know it's going to increase. All right. That doesn't increase it much at all. And we're still at 65. So the only thing that I can think of is I don't think that we're going to get a gross margin more than 80%. Like I said, if we do, at some point that's going to become a real problem. But what we can do though is we can definitely decrease the revenue. And so what we can assume is that maybe even though the revenue has increased by a lot over the last 3 years, we can just assume that revenue stays pretty much flat, right? And so if we do that, see, that gives us a net profit of 43, which is a decline from the 90 last year. And we know that that's not going to happen. So let's go back and make this number the the 9,000 that it was on the tax side. Wait a minute, what happened here? 30. Oh, no, 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 no. See if that works. Hmm, I don't remember what I did. Get that 9,000. Had to be had to be an average. I don't remember. So let's just make it 95. Okay. Still puts us in the negative. Foreign currency. Let's go back and make this one. Assume that the foreign currency stays where it is. Let's assume that that investment loss falls off and still at a loss. Let's go back and reduce payroll, still at a loss. Um, we can increase the, let's assume revenue increases by, and we'll just have to play around with this. Let's say it increases by 25%. That gives us growth of 14%. And so let's now just say 35%. That gives us closer to, I think, let's say 30%. All right, there we go. So an increase in revenue of 30%, um, even though, like I said, it's it's been 25 and 120 last year. If it increases 30%, that gives us a net profit improvement of 23%. If I come back and add the investment thing, that gives me a little room to play around with the revenue again. So that gets us to a net profit increase of 26%, which is more in line with, I think, where it has been over the last 3 years, even though revenue has increased by so much. All right. So that gives us earnings per share of $1.34. Again, this does not include any impairment charges or depreciation that typically shows up on the financials when you're looking at a profit loss statement. PE is a 6, and so that just means that the stock price is 6 times what the net profit is. That is 28% of the stock price. Now, historically, the highest has been 11% of the stock price. The lowest has been 39% of the stock price. And then we see 26, and then 77, 16, and then 27. What's important about this is remember back on the balance sheet in 2019 and 2020, these numbers were kind of crazy compared to 2021. But looking now at the profit loss statement, these numbers, even though they are different, they're definitely more in line with kind of where we are today. So again, in 2019, the stock price went from 16% of a net profit to 27% of net profit. It did get really low in 2020. 77% of the stock price was part of the net profit. Then 11 to 39, which I think is probably going to be the high. So we're currently at 28, which 28 is really in between 2021 and at the top end of 2020, and then again at the bottom end of 2019. So it's still kind of all over the place, but I think it is more in line with where it currently is. And so I'm going to say that this particular stock price moves much more in line with net profit than it does with the balance sheet. So that gives us a low end price of $3.37. And that gives us a high of $8.47. We know that the stock price has definitely been up to this $9 range, and so I don't see that as out of the realm of possibility. With again the fact that they are growing net profit consistently over the last 3 years, I expect that to continue. And based on these numbers, we're only looking at a 26% increase in net profit, which is pretty much in line with what they've done recently. I'm comfortable enough to say that currently at $4.77, that the company is, fairly valued to undervalued. In the year of 2022, let's see if I have this queued up. I don't think I do. Yeah, okay. So $8.97, and this was October 31 of 2021. And so when we get to 2022, stock price has not been above the $6.50 number. So I think that over the course of the next year, we can definitely get back to that $8 and change. And looking again just at the technicals, this purple line is the 200-day moving average. Let me blow this up. All right. So the purple line is the 200-day moving average. It is below that, but it's still above the 50-day moving average. And so that means that the stock isn't quite in bear territory yet. It is important to note that if it does break through this 50-day moving average, we can definitely see a move back to our, well, not a move back to, but a move to our low. Uh, let me get back to it. There we go. We can definitely see a move back to our low of $3.37. Okay. This confuses me every time. There we go. Yeah, we can definitely see a move down to that $3 and change I mentioned before. Um, if it bounces off of that 50-day and it gets above the 200-day, that's a very bullish indicator. And then we're looking at an $8 stock at that point. Again, there is a lot of excitement concerning the the new business that they're going into. The only risk that I see at this point is coming from this gross margin. This gross margin was something that was mentioned by analysts during the earnings call. So obviously, it's something that is going to be critiqued. It is also something that was mentioned by the CEO in the earnings call. They talked about, wanting to really monitor, and they were happy with kind of where they were in that regard. So again, if this gross margin continues to increase, that's going to be an issue. But as of right now, though, everything really does look good for the stock. Like I said, 477 is where it is now, and that's kind of right in the middle of where I think this stock can definitely go. It hasn't seen its high yet, and so I definitely think it gets back there. Let's see what else. This is for us. Um, the other thing, I just want to reiterate this. In 2021, kind of sort of a, I don't know, it's kind of, you can call it a breakout year, right? Maybe this is what the company is going to look like from here on out, right? And if that's the case, then this 28% makes a lot of sense when looking at the low and the high of where the stock can go. If though the company kind of reverts back to its old, I don't know, valuation, right? Then at that point, we're looking at a stock that basically isn't going anywhere. It could potentially go lower. Um, so the question becomes, is this one of those, um, you know, meme stocks, or one of this, very popular stock that's going to get a lot of buyers, or is this a stock that people are expecting to fail, right? So let's take a look at the short interest on this thing. I don't have this queued up, but I'm sure I'll be able to find it easily. And the reason why I'm curious about this, and I haven't looked at this before, but I am now, because if the short interest is relatively low on this thing, then we can assume that this is going to be a popular stock, that it's new, right? It's new, and it's going to perform as it has over the last year. Let's see. So here we go. So short as of May 2022 is 2%. 2% is not a large number, um, but it is a number to look at. Let's see what their competitors are looking like, if I can find this. Because if their competitors are also in that 2% range, then we know we're good. remember where the competitors are on this thing. So these are not necessarily competitors, but Yahoo says that they're similar. So let's look at just look at one of these here. And we'll look at a couple. Just cause. All right. So this is yeah, Igna. Don't know a lot about this company, but they're all right. Yeah, short as of May 22, 4%. So there you go. Um, obviously, obviously, the market is expecting this company to fail way before EVC does. Let's take a look at this other one, and then I'll look at one of those dollar ones too, just because sometimes the actual stock price itself has a lot to do with the type of investor um, that that gets into the stock. Let's see what we're doing here. All right, short. Look at this, almost 7%. That's crazy. My goodness. And the reason why this is interesting to me because, like I said, in my opinion, TV radio is a declining business, but it is still a business, and so I imagine that there's a lot of people out there, a lot of investors that are are betting on these companies to fail. All right, let's look at another one. Yeah, this BBGGI. So when you have a stock that's, costs like $1 or something like that, you'll have a lot of speculative investors that want to spend what money they have to buy a lot of shares to try and make as much money as possible. And then what happens is they will sell those shares for profit just as fast. And so a lot of times that means that you'll either have a lot of volatility in a stock, or that means that when the company does do something well, the stock price goes like crazy. All right, so yeah, and so this ratio is only um, 0.1%. So there's hardly no one that's short this thing, and I bet you that has a lot to do with the stock price. So again, going back to our Entravision, because the short ratio is where it is, because the stock price costs what it costs, I am confident to say that this company is currently undervalued and that the downside risk is only down to that $3.30, 7 cent range. And that's only if it falls below its 50-day moving average as well as the 200-day. If it stays above that 50-day, it can definitely rebound back up to that $8, $9 range, no questions about it. So again, 337 to 847 in the year of 2022, and the stock is currently undervalued.